Hey guys, what's up? In today's video, we are going to talk about how much money you actually need invested to live off of dividends. Now, the reason for this video is because I had a friend come up to me last week and she wanted to get to a place where she basically never had to work again. And at that point, I was like, well, yeah, everybody would love that. So my next question to her was basically, how much would you need on a yearly basis to be comfortable and happy with your dividend income? She thought for maybe about 30 seconds. And then what she told me was she would like to have around $3,300 to $3,500 per month, which comes out to around $42,000 per year. Now, depending on who you are, it could be either a little bit more than that or a little bit less than that. But for most people, I think 40,000 is a pretty reasonable number. So today we're going to cover the math behind how much exactly you need invested to live off of dividends, why investing in dividends shouldn't be your only strategy, and if you are able to get to the point where you can basically live off of your dividends, we should talk about the best methods to actually achieve this. So make sure you hit the like button on this video and let's get into part one, which is the math of this whole problem. So let's say you want $40,000 a year in dividends. Well, that really depends on how much you have invested into what exact holding that you have invested. So using the example from our intro, let's say we want $40,000 a year in dividends. Well, that's going to really depend on what we're investing in and what the payout rate or the percentage yield of what our total investment is actually going to be across our entire portfolio. All right, so let me give you an example. Let's say you bought Apple stock. Well, Apple stock on dividend.com, it pays 92 cents for every share of Apple that you own on a yearly basis. That means if you own a share of Apple, which roughly costs between $145 and $150 at the time of this recording, you are getting 92 cents for every share that you own passively every single year. Now, the dividend yield then is 92 cents divided by the share price. So let's use $150 as our example. It would be 92 cents divided by 150, which is 0.61%. That would be the yield. Now, this yield percentage is the number that you want to pay attention to. Essentially, what this percentage is telling you is that for every $100 that you guys have invested in this particular stock or holding, that's how much of a percentage you're getting back every year in passive dividends. So in the case of Apple, if you put $100 into Apple stock, you would get 0.61% of it, or around 61 cents per $100 every single year back as a dividend. Now, if you wanted to get to $40,000, then you could see where this becomes a huge problem because you need a lot of money invested in Apple. But I think the good news here is that most dividend paying companies will pay higher than 0.61%. If we actually take a look at the Dividend Aristocrat list of 65 stocks, there are 65 members of the S&P 500 that haven't just paid dividends for at least 25 consecutive years. They've actually raised their dividends for a minimum of 25 years as well. So basically, if you invest in Dividend Aristocrats only, you know that your dividend is likely safe and it's likely appreciating over time, as in it's getting raised over time. Now, if we actually scroll down the list, we actually see on average that the dividend yield percentage for all Aristocrat companies is somewhere between 1% and 4%, depending on the stocks that you hold. So that's definitely a lot higher than Apple's 0.61%. So if we actually take one of the more aggressive stocks in the Dividend Aristocrat list here, 3M, for example, their current dividend yield is around 4%, 4.02% at the time of this recording. That means if you had your whole portfolio in 3M, you would need way less invested to get to that same $40,000 a year that you would with, say, just Apple. In fact, the numbers are pretty crazy. If you just held Apple stock, you would need $6.557 million invested in Apple stock just to get that $40,000 a year passively. With 3M, since it's paying a 4% dividend, you would just need $1 million invested in 3M alone. So you can see how big of a driver your dividend yield is for figuring out how much you need invested to passively live off of it. In a well-diversified portfolio, you're typically going to have varying stock holdings, and I would say the average dividend yield of a good, well-diversified dividend stock portfolio is somewhere between 2 and 4%. I'm going to bring up a table right here. With this table, you're going to see exactly how much you need invested to generate $40,000 a year at each dividend yield percentage. As you can see, the more that your average yield percentage is, the less money you will need. So at 3%, you will only need $1.33 million invested, and at 5%, you would need $800,000 invested to get that same $40,000 a year. But let's use the average dividend portfolio of 2 to 4% of a yield. That means the amount that you need invested is somewhere between $1 million and $2 million. Now, it's usually at this point that somebody asks me, hey, Humphrey, why don't you just put all your money in a higher dividend yield paying stock? For example, AT&T, they pay a dividend of 5.24%. Why don't you just dump your entire net worth into that? So here's the exact reason. I'll pull it up on the screen right now. If you look at the past 5 years of performance for AT&T and also just the entire performance of AT&T, you can actually see that they're just trading sideways basically since the year 2002. So to understand why this is trading sideways, we have to understand more than just market forces. We have to understand how a dividend is actually paid out and how it works. Companies often pay dividends to reward their shareholders. It's basically a percentage of profit that the company passes back to you. While a high dividend yield sounds good, it can actually hurt a future company's growth because they are basically paying out all of their profit instead of reinvesting back into itself. So companies with high dividend yields are basically telling you that the management thinks that it's better to just pay out dividends rather than reinvest in itself, which speaks volumes about those businesses. And that kind of gets me into part 2 of this video, which is the harsh truth. So here's the harsh truth of dividend investing that people don't really talk about on YouTube, with the exception of Larry Chung. He is a CFA that has made a few videos here on YouTube about dividend investing, and I found one of his insights very powerful that I want to share with you guys today. Basically, if we take a look at the financial data across the United States, we'll see that the median net worth and the average net worth by age group in the United States is going to be quite low. You'll see that if you're the age of less than 35 or younger than 35, your average net worth is $76,300, while your median here is $13,900. If you're between the ages of 35 and 44, your average net worth is $436,000, and when you reach your mid 40s and 50s, it becomes $833,000. Now, you'll also notice the difference between the median and the average net worth in this table, and the reason for that is that wealth is typically skewed toward the higher end of the spectrum, so there are a lot of outliers on the wealthier side, and therefore the average in this case is actually probably a little bit more than, say, just average, if that makes sense. Anyways, even at the age of 45 to 54, if we take this entire person's net worth of $833,000 and you put it into a 4% dividend portfolio, that generates you about $33K a year in dividends, which still doesn't hit our $40K a year passive income goal. It also doesn't take into account that the average net worth is comprised of things like your home, your car, and other types of investment assets. So really, in order to get to a place where we're generating enough income off of our investments, what should our strategy be? And this is actually going to lead us into part 3. If we are young, which according to my YouTube analytics, a lot of you guys are, in fact, 74% of you guys are under the age of 34. If we are young, we want to have a different strategy than just dividend portfolio investing. It's likely better to invest in growth rather than dividends, especially early on, and there are going to be 3 reasons why it's better to invest in growth over dividends. The first is that you can afford to take more risk when you're younger. So let's say you only had $1,000 to invest. If you put it in a dividend portfolio that generated you 5% a year, that's really just $50 a year without much appreciation at all. That dividend yield is hardly going to make a dent in your overall portfolio, so it's probably better to try to grow your capital as quickly as you can when you're young. And that's basically number 2. You want to grow your capital gains as much as you can when you're young because you can afford to take on more risk. Now, number 3 is the concept of compound interest. The earlier you get started in investing and grow your capital to a sizable enough figure, the more that compound interest and time is going to multiply that original size of your capital. Basically, you want to be building up your total investment balance using time as an advantage here. So therefore, the strategy should be the other way around. When you are young, you are trying to build up your investment portfolio as big as you can so that when you are older, you can convert it to something that pays you a little bit more consistently and safer, like a dividend stock portfolio. That's because when you're older, you have less room to make mistakes in your investment portfolio. For example, let's say you're the age of 55 and you've YOLO'd your entire net worth into AMC like about 2 years ago, you could be in the dumps and your retirement would be threatened. Ideally, while you're leveling up your investment portfolio, you are also diversifying across different types of assets, such as real estate, bonds, CDs, any alternative assets that basically can pay you a little bit of income while you're still growing your total investment portfolio. All right, let me share with you guys one more table that I found, and this one comes courtesy of financialsamurai.com. By the way, I will link financialsamurai.com and Larry Chung's video in the description below if you'd like to check that out after this video. So basically what this table shows you is that for his entire investment portfolio of, let's pretend it's $1 million, he would have 60% in index funds, 20% in bonds, which I don't really agree with, but I'll save that for a different video, and 20% in individual stock selections. So for the 20% of his individual stock selections, the $200K, he suggests to split it up in this manner. You can see that when you're below the age of 30, you're going to be basically 100% in growth stocks for your stock portion of your portfolio. Now, when you hit the age of 31, that's when you can start easing dividend stocks into your overall mix. Now, there are a bunch of different ways to create a portfolio. This is just one method. And a quick disclaimer, guys, whenever you're watching a YouTube video on YouTube, for example, and they're trying to give you suggestions on how to invest, know that it's basically a blanket statement, or it's a video targeted at the general masses. It doesn't mean that it's exactly right for you. You need to really do your own due diligence. You need to check out what your risk tolerance is, and you need to figure out what your time horizon is when you're investing yourself. So whenever you are watching something like this video on YouTube, make sure to take it with a little bit of a grain of salt and make sure to do some critical thinking, because it's going to really help you figure out what decisions are good for your own portfolio. All right, now for part 4, which is my favorite part of the video. It's probably the most important, but many people will think it's boring, but it's actually called tax considerations. Now, if you are really interested in living off of your dividend income one day, you really want to pay attention to this section. So let's pretend you hit $1 million in your portfolio and your dividends are paying you around 4%. So you're at that magic number of $40,000 a year. Now, this is the best part, because under the IRS tax code, anything that you make under $40,000 and $400 is taxed less. It's actually taxed at 0%. Any earnings from $40,401 to $445,850 is taxed at 15%, and anything above that is taxed at 20%. Now, dividends from companies that you receive are usually taxed either at ordinary income rates, or they're called qualified dividends, and qualified dividends will basically qualify you for those capital gains rates I just mentioned. There are a lot of specifics on how dividends are taxed I'm not going to get into today, but basically if you're holding a dividend company for longer than 60 to 120 days, you likely have qualified dividends, which means that you qualify for this better tax treatment. So if you ever are getting close to this magic number, you also want to pay attention to the capital gains taxes, because that's going to also play into the math that you need to figure out for how much you need invested to live off of dividends. Now, if you want to avoid taxes altogether, you can invest in something called a Roth IRA, and that's a special individual retirement account. The main advantage of a Roth IRA is that when you retire, all your earnings and your profit that you earned in the Roth IRA grow, and they get withdrawn tax-free. That's the biggest benefit of this account, and because it's such a good account, the government actually limits how much you can invest in a Roth IRA every single year. If you're under the age of 50, you can only contribute $6,000 a year into your Roth IRA, and if you're over the age of 50, you can contribute $7,000 a year. The other downside is that you need to wait until the age of 59 and a half before you withdraw any of your gains from a Roth IRA, because the government wants to basically incentivize you to save for your retirement. If you withdraw before the age of 59 and a half, you take a 10% penalty on those earnings, so that's why they want to disincentivize you from doing that. So if you are a stickler for taxes, you might just want to consider investing in a Roth IRA. I have a ton of videos on the Roth IRA on my channel, which I will link down below as well. The general rule that I want you guys to take away from this video is when you're trying to figure out how much you need invested and how much you want to live off of, there is a great formula for that. So the formula is dividend income divided by dividend yield percentage. So if you need $75,000 a year to live passively, you will divide it by your target dividend yield percentage, and that will tell you exactly how much you need to have to live off those investments. So in our case, 75,000 divided by 5% or 0.05, you got to move the decimal over. That's $1.5 million that you need invested to generate that $75,000 in passive income. That's the formula that you hopefully take away from this video. So let me know what you guys thought of this video. How much do you guys want to live off per year? Let me know in the comments, or just send me a DM. I'll make sure to link those videos right here that I was talking about, the Roth IRA, as well as how to build your own portfolio. If you're new to investing, make sure to grab some free stocks in the description below. Lastly, make sure to sign up for my newsletter. It's a free business newsletter that comes out on Wednesdays and Sundays. It's called Hump Days, and it's completely free to sign up. That's also linked down below, and I will see you guys in the next video. I appreciate you guys being here. I'll see you later. Peace.